Good day, everyone. Welcome to my channel. This is brought to you by Finance Foundation 101 Plus channel. To support my channel, kindly subscribe, like, share, drop comment, and turn on your notification button for my subsequent video. What I'll be sharing with you today is the difference between saving and investing, also on how to invest in stocks, bonds, ETFs, and index funds. To understand this topic better, I will suggest you watch my two previous videos titled Investing 101 for Beginners and What is Investing and Why It Matters. This video is a continuation class from my previous videos. Let's begin. The difference between saving and investing. Introduction. Today, we will delve into a critical topic in personal finance, the difference between saving and investing. These two concepts are often used interchangeably, but they are fundamentally different. Understanding the distinction between them is vital for anyone who wants to build a secure financial future. Let's start by defining each term, explore how they differ, and examine their purposes, benefits, risks, and practical applications. 1. Definition and core concepts. What is saving? Saving is the act of setting aside a portion of your income for future use. Typically, this money is placed in low-risk, highly liquid accounts, such as savings accounts, money market accounts, certificates of deposit CDs. The primary goal of saving is capital preservation, ensuring that your money is safe and easily accessible. What is investing? Investing, on the other hand, is the process of using your money to buy assets that you expect to increase in value over time. These assets can include stocks, bonds, real estate, mutual funds, ETFs, exchange-traded funds. The goal of investing is capital appreciation, growing your wealth by earning returns over time. 2. Purpose and goals. Saving. Short-term financial goals, e.g. vacation, emergency fund, down payment on a car. Emergency preparedness. At least 3 to 6 months of living expenses, low or no risk tolerance. Immediate or near future accessibility. Investing. Long-term financial goals, e.g. retirement, college education for children, buying a home in 10+ years, building wealth over time. Higher risk tolerance with the potential for higher returns. Less concern about immediate access to the money. 3. Risk and return. Saving. Low risk. Your principal is safe. Accounts are often insured by government agencies, like FDIC in the US. Low return. Interest rates are generally low, especially during periods of economic stability. Inflation risk. Returns may not keep pace with inflation, eroding your purchasing power over time. Investing. Higher risk. There is the potential for loss. Markets can be volatile. Higher return. Historically, investments like stocks have outperformed savings in the long run. Inflation protection. Investments, particularly in equities, often outpace inflation. 4. Liquidity and accessibility. Saving. Highly liquid, funds can be accessed quickly and easily. No penalties, in most cases. You can withdraw your money without losing value, though some accounts like CDs may charge early withdrawal penalties. Investing. Variable liquidity. Some assets can be sold quickly, e.g. stocks, while others, e.g. real estate, take time. Potential penalties. Early withdrawal from retirement accounts can incur penalties and tax consequences. 5. Time horizon saving. Suitable for short to medium-term goals, usually less than 3 to 5 years. Investing. Best for long-term goals, usually more than 5 years, to weather market fluctuations and benefit from compounding returns. 6. Examples to illustrate. Let's consider two people, Sarah and James. Sarah is saving for a vacation next year. She puts $5,000 into a savings account earning 1% interest. In a year, she has $5,050. Her money was safe and easily accessible when she needed it. James is saving for retirement, which is 30 years away. He invests $5,000 in a diversified stock portfolio. Assuming an average annual return of 7%, his investment could grow to over $38,000 in 30 years. However, he experiences market ups and downs along the way. Sarah prioritized safety and access. James prioritized growth and time. 7. Psychological and behavioral aspects. Saving provides peace of mind, especially in uncertain times. People feel safer knowing they have cash readily available. Investing requires patience, discipline, and emotional control.
Market volatility can lead to panic selling or irrational decisions. That's why financial literacy and psychological readiness are key components of successful investing. 8. Complementary strategies. Think of saving and investing as complementary tools. Step 1. Build your emergency fund through saving. Step 2. Once the fund is established and debt is managed, allocate excess income toward investing. Step 3. Diversify your investments and monitor them periodically. By doing both, you create a balanced financial life that prepares for the present while building for the future. 9. Conclusion. Let's recap. Saving is about safety, a beginner through more advanced considerations. Investing in stocks, bonds, ETFs, and index funds. Lecture title: Building Wealth Through Intelligent Investment. Part 1. Understanding the Basics. 1.1. What is investing? Investing is the act of allocating money to an asset with the expectation of generating income or profit over time. The goal is to make your money work for you rather than keeping it idle. 1.2. Why invest? Beat inflation. Money loses value over time. Investments grow your capital. Grow wealth. Create long-term financial security. Reach goals. Buying a house, retirement, education, etc. Passive income. Certain assets generate income streams. Part 2. Investment vehicles explained. Let's explore 4 of the most common investment vehicles. 2.1. Stocks. What are stocks? Stocks represent ownership in a company. When you buy a stock, you become a shareholder, which entitles you to a portion of the company's profits via dividends and potential value appreciation. Types of stocks. Common stock, voting rights, potential dividends. Preferred stock, no voting rights, fixed dividends. Pros: high return potential, ownership and dividends. Cons: volatile and risky. Prices can swing based on market sentiment. How to invest. Open a brokerage account, e.g., Fidelity, Vanguard, Robinhood. Research companies. Analyze financials, growth potential, market trends. Buy shares and hold or trade depending on your strategy. 2.2. Bonds. What are bonds? A bond is a loan you give to a company or government in exchange for periodic interest payments, called coupons, and the return of the principal at maturity. Types of bonds. Government bonds, e.g., U.S. Treasury bonds. Municipal bonds, issued by states or cities. Corporate bonds, issued by companies. Pros: lower risk than stocks. Predictable income. Cons: lower returns, sensitive to interest rate changes. How to invest. Direct purchase from the government, e.g., treasurydirect.gov, through brokerages or bond mutual funds. Via ETFs that specialize in bonds. 2.3. ETFs. Exchange-traded funds. What are ETFs? ETFs are investment funds that trade like stocks but hold a diversified basket of assets: stocks, bonds, commodities, etc. Key features. Traded on stock exchanges. Offer diversification with a single purchase. Low expense ratios. Example ETFs. SPY tracks the S&P 500. QQQ tracks the NASDAQ 100. BND tracks the total bond market. Pros: easy diversification, low cost. Liquidity, can buy, sell anytime markets are open. Cons: still subject to market risk. Some ETFs are complex, e.g., leveraged ETFs. How to invest. Open a brokerage account. Choose ETFs based on asset class, sector, or goal. Buy and hold or rebalance regularly. 2.4. Index funds. What are index funds? Index funds are mutual funds or ETFs designed to mirror the performance of a market index like the S&P 500. Differences from ETFs. Mutual fund index funds trade once per day. ETFs trade like stocks throughout the day. Index funds are typically passively managed. Pros: very low fees. Long-term market performance. Great for beginners. Cons: less flexibility than individual stocks. Market exposure means potential losses in downturns. How to invest: through brokerages like Vanguard, Schwab, or Fidelity. Choose based on index, S&P 500, total market, international, etc. Automate contributions for dollar cost averaging. Part 3. Building a strategy. 3.1. Set your goals. Ask yourself, what is the purpose of your investment? Retirement? House? Education? What is your time horizon? What is your risk tolerance? 3.2. Diversification. Don't put all your eggs in one basket. Mix of stocks, bonds, ETFs. Domestic and international exposure. Different sectors and industries. 3.3. Asset allocation. A key part of strategy. Young investor. More stocks, e.g. 80% stocks, 20% bonds. Near retirement. Conservative, e.g. 40% stocks, 60% bonds. Adjust annually or with life changes. 3.4. Dollar cost averaging. Invest a fixed amount regularly, regardless of market conditions. This reduces the risk of investing a lump sum at the wrong time. Part 4. Tools and accounts. 4.1. Types of investment accounts. Brokerage account. Taxable, flexible. IRA, individual retirement account. Tax advantages. 401k, employer-sponsored retirement plan. Roth IRA, pay taxes now, withdraw tax-free in retirement. 4.2. Robo-advisors. Platforms like Betterment or Wealthfront manage your investments using algorithms, great for beginners or passive investors. Part 5. Risks and mistakes to avoid. 5.1. Common mistakes. Panic selling during downturns. Trying to time the market. Ignoring fees, they eat into returns. Chasing past performance. Not staying invested long enough. 5.2. Understanding risk. All investments involve risk. Learn. Market risk. Broad market declines. Interest rate risk. Bonds fall as rates rise. Inflation risk. Returns may not outpace inflation. Part 6. Continuing education. Recommended resources. Books: The Intelligent Investor by Benjamin Graham. A Random Walk Down Wall Street by Burton Malkiel. Common Sense on Mutual Funds by John Bogle. Websites: Investopedia, Morningstar, FINRA and SEC educational tools. Courses: Coursera, Financial Markets by Yale University, Khan Academy, Finance and Capital Markets. Conclusion: Your investment roadmap. To summarize, step and action. 1. Educate yourself. 2. Set financial goals. 3. Choose investment vehicles. Stocks, bonds, ETFs, index funds. 4. Open appropriate accounts. 5. Build a diversified portfolio. 6. Invest regularly. 7. Rebalance and review annually. Final thought: the stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Patience, discipline, and continuous learning are your greatest tools as an investor. Start small, stay consistent, and let compound interest do the heavy lifting. I am convinced you've learned something new or more from this lecturing class. However, for better understanding on this topic,
I'll advise to check my previous videos titled Investing 101 for Beginners, What is Investing and Why it Matters. This is a continuation of it, and more so, this video will also continue in another upcoming video, so watch out. This is brought to you by Finance Foundation 101 Plus channel. To support my channel, kindly subscribe, like, share, drop comment, and turn on your notification button for my subsequent video. See you all in my continuation video. Bye for now.